In almost every area of life, we are taught that effort equals outcome. If you want a better career, you work longer hours. If you want a better garden, you pull weeds every day. Constant hyperactivity gets results. But when you apply that exact same hustle to your investment portfolio, it becomes a financial wrecking ball. Psychologists call this the action bias. When we face uncertainty, our brains are hardwired to do something. We feel safer actively meddling with our money rather than watching it sit there. To beat this, we have to adopt a completely different mindset. Meet our guide, MR. He represents a stripped-down, zero-friction approach to financial markets. Building generational wealth doesn't require a master trading algorithm. It requires building a system that actively blocks your own instinct to fiddle with it. The modern financial ecosystem is designed to exploit that instinct. Zero-commission trading apps, constant push notifications, and 24/7 news tickers are engineered to make you react. Every time you yield to those triggers, you introduce invisible financial friction directly into your portfolio. That reassuring feeling of control you get from actively managing your trades is exactly what is slowly draining your net worth. To see how active trading destroys capital, we have to look at two specific mechanisms. The first is short-term capital gains tax. This chart shows how a compounding block of capital gets continually sliced down. Every time you sell a stock for a profit within a year, the government can take up to 37% of those gains before they ever have a chance to compound. The second mechanism is behavioral slippage. This is the highly predictable human pattern of buying heavily when a stock is hyped and panic selling the moment the market drops. Combining constant taxes and bad timing creates a permanent downward drag on your portfolio's overall momentum. Because of this structural drag, frequent active trading mathematically ensures you will underperform against a completely frictionless strategy. Let's run a test. We will track two identical $50,000 portfolios over a 20-year horizon. On this chart, Mark actively trades high beta stocks. His line fluctuates wildly, plateauing due to constant taxes and fees. Sam takes a passive approach. By deferring taxes and eliminating transaction costs, his portfolio hits an exponential compounding curve, leaving Mark in the dust. Sam didn't win by picking better stocks. He won through the absolute elimination of transaction friction. This zero-friction approach has a name. In 1984, portfolio manager Robert Kirby introduced what he called the coffee can framework. He based it on a physical metaphor from the Old West. You purchase high-quality assets, seal them inside a coffee can, put it under your mattress, and intentionally ignore it for decades. The true value of the coffee can strategy is that it functions as a behavioral straitjacket. It forces a state of calculated ignorance, locking you out from meddling with your own success. To apply this extreme long-term holding safely, you have to follow a few strict rules. Rule 1. Eliminate all sell-side decisions. Your initial capital must be allowed to compound tax-free without interruption. Rule 2. You must aggressively mitigate single company default risk. Buying and holding one individual speculative stock forever exposes you to catastrophic losses if that business fails. This is where broad market index funds come in. As we see here on the scale, instead of risking your capital on a single volatile stock, an index fund provides built-in diversification by buying a slice of the entire market. The math of doing nothing only works when your assets are broadly diversified enough to survive the decades. So here is your action plan. Step 1. Build a core portfolio focused strictly on these broad, diversified index holdings. Step 2. Automate your monthly financial contributions. Remove human decision-making entirely so your money buys in regardless of what the market is doing. Step 3. Delete the tracking apps. Stop checking daily prices and turn off the financial news. Wealth creation does not reward constant movement. It rewards careful initial selection, radical patience, and the discipline to step aside and let the math work.